According to the Financial Stability Board, non-bank financial institutions, or the buy-side or NBFIs, now account for nearly half of the global asset under management. These institutions rely heavily on collateral transformation to implement their investment strategy, and the repo market is pivotal to that process. Yet, despite their scale and sophistication, there is no peer-to-peer repo among the buy-side community, between the cash lender and the cash borrower. This absence is not incidental. It stems from two structural constraints. Firstly, NBFI are often restricted, either by internal risk policies or external regulators in terms of which counterparties they can transact with. Secondly, a peer-to-peer market will require an active management of the maturity mismatch. Most NBFI are either not equipped or not willing to take on that maturity transformation, preferring to avoid the operational and risk management burden it entails. As a result, most of the buy-side repo activity is intermediated by banks. Now, this setup works reasonably well in normal conditions, but in time of stress, whether due to collateral scarcity or market volatility, it exposes a key vulnerability for the buy-side, an over-reliance on bank intermediation. Banks' ability to intermediate is constrained by their balance sheet and capital, and these resources are not infinite. When markets experience a shock, those resources tend to contract, reducing bank capacity to intermediate, and in turn, limiting buy-side access to liquidity. This challenge has placed liquidity risk and liquidity preparedness for the NBFI high on the agenda of regulators in the recent years. The benefits of centrally cleared repo transactions are already well understood in the interior market, where over €1 trillion is cleared on a daily basis at LCH RepoClear, regardless of the market condition. Extending clearing access to the buy side via their dealer can unlock additional intermediation capacity, and there are two main reasons for that. Firstly, the netting benefit under the leverage ratio are calculated at the clearinghouse level, not at the counterparty level. Secondly, the capital requirements for cleared trades are lower than for bilateral ones. For dealers, this means more intermediation capacity